Drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
Hello students, welcome to atptable.com, your online gateway to the world of invaluable knowledge. During the last discussion, we were trying to understand the application of the concept of present value in the case of the growing annuities. So let's proceed, students. The derivation of the final formula may take place under the light of the three conditions. Once again, students, the derivation of the final, as I already said, that the derivation rests heavily upon the interaction between these two variables, that is I and G. Therefore, the derivation of the final formula may take place under the light of the three conditions, wherein I is more than G, I is less than G, and I is equal to G. Once again, students, the three conditions which have been laid down as a precursor of the interaction between these two variables of I and G, they take three shapes, that is, when the I is more than G, I is less than G, and I is equal to G. We all know I stands for discounting rate or required rate of return, and G is the growth rate. So more often than not, we will find that G is on the numerator part and I is on the denominator part. Now the first condition is where the I is more than G. So where the I is more than G, it means that it leads to a condition where the discount rate is more than the growth rate, or the other way around, the growth rate is less than the discounting rate or the required rate of return. Now this is the most common condition wherein the rate of return is greater than the growth rate of the annuities. You might be wondering that why is it so that the condition wherein the growth rate is lesser than the discount rate, or the discount rate being more than the growth rate, is quite a normal feature. It's quite a common thing to come across. You must be wondering that why exactly is this particular thing taking place? Didn't we discuss this thing that I is a discounting rate, and discounting rate being used as a denominator, as a discounting factor, reduces the future value to a lesser amount of comparable present value, and then again the growth, which apparently it looks as a very positive thing, that should be lesser than the discount rate. So exactly what is happening? So students, let me tell you one thing. You are very right to wonder about this thing, that why exactly this particular thing is happening, that the growth rate should be lesser than the I or discount rate. Why this particular condition is being upheld, why it is being celebrated, why it is being prescribed. Now the actual reason shall become even more clear to you when we shall be discussing the next chapter, that is the valuation of shares and bonds. But right now I will just give you a passing reference, that I will try to make you understand this concept from two points of view. First, from the point of view of an investor, and second, from the point of view of the company. From the point of view of the company, I will just give you a hint, I will just give you a passing reference. I won't be dwelling deeper into that, because right now it is not very essential. It is going to be essential in the next chapter of valuation of shares and bonds. But yes, its interaction or its impact from the point of view of an individual investor is much more relevant in this particular case. So let's first try to discuss that how exactly the case of companies this rule stands tall. But as I said, this rule stands tall in the case of both the entities, whether it is an individual or whether it is a company. The only thing is that the discussion becomes more elaborate over here, or more relatable over here, in terms of an individual investor, while in the case of a company, these things will be more clear when we take up the next lesson. So one thing, students, from our very first discussion regarding time value of money, when we were in the nascent stages of discussion regarding time value of money, you might be wondering, I said something regarding the RS, or the required rate of return. I also said that the RS, or the required rate of return, actually acts as a bare minimum rate of return which investors always want. You might recollect I used the term CAPM, it is a capital asset pricing model, using which we try to calculate the value of RS. RS referred to the required rate of return from a security, which was a function of RF plus beta times within bracket RM minus RF. We calculated all these things, and by looking at the conceptual framework also, we try to understand a CAPM model helps a lot the investors, the companies, in calculating the RS or the required rate. They should try to expect from the asset, or whether it is a financial asset, whether it is a capital asset, or any kind of an asset, where from they are trying to put their investments into. We also try to understand from the time value of money concept also that current consumption, current money lying at the disposal is of much more value, because they can be spent, they can be consumed, they can be speculated against, rather than the money with which we are parting from. And if at all a need arises for parting away from the money, then obviously the investors are absolutely right in demanding a required rate of return, or a RS, from the companies, or any other investment avenue wherein they are supposed to put their money, wherein they're expected to put their money. The same rule applies over in the case of the companies also. When the shareholders who have supplied the company with the capital, not only shareholders, the debenture holders, the bankers, all those people who have helped the company in meeting their financing decisions, that is, those decisions where from the companies are raising their finances from. So they are very right in having an estimation regarding the required rate of return on their investments which they have made into a particular company. But when they have made the investments into a particular company, obviously at the time they might have calculated the required rate of return of this from investments which they are making forth in the company. They might have taken into consideration both the part, that is a risk-free rate of return as well as a risk premium. And since we know that company is a long-term entity, it has got an infinite life, it has got a going concern concept, so all the investment, all the asset purchases, they are being taken up with a long-term point of view, with a very, very long-term point of view. So somewhere or the other, the investors who are providing the company with the capital, they know that they are dealing with a very long time horizon, wherein the prospects of the risks are always more, the prospects of risks are always greater, the uncertainties are quite high. And we all know that companies also work in a very different macroeconomic conditions. They're always fraught with different kinds of risks. There are some there are macroeconomic risks, there are inflationary risks, there are market risks, there are liquidity risk, technological risk, operational risk, inflation risk, risk from the competition. And nowadays we find that everyday companies are faced with a larger share of the risk, because now disruption is coming up. Technology is wreaking havoc. Technology is keeping the companies always on their toes. Consumer demands are changing, consumer states are changing, disposable income are changing. In a nutshell, we can say that companies are working in a more dynamic and a more volatile economic environment, business environment. So over here, investors are always wary about the safety of the investment, so they always try to put a rate which is quite high, the discounting rate or the expectation rate from the company, or the required rate of return from the overall company against the securities which they have invested into. It is quite high, so the I is bound to be high. That is a risk premium, or the RP factor, which is a quintessential part of the entire RS calculation. That RP is quite high in the case of the long-term investors. So this explains that why the I factor is always on a higher side. Now coming to the growth part, students, when you just undertake a walk in a kind of in a meadow, or when you take a walk into a forest, you find that there are very lofty trees. Whenever you see a trees, you might be wondering that the trees are so tall, they're so lofty. But no matter how tall a tree is, have you ever seen a tree growing past the sky, or the tree growing past the clouds? Obviously not. Neither of us has ever seen that. Why? What does it mean? It means that no matter how much you are growing, there is always a limitation to your growth. Same happens in the case of the company also. Companies do grow, companies are expected to grow, their earnings expected to grow, their business is expected to grow, their cash flows are expected to grow. But no matter how much a company is growing, no matter how profitable a particular company is, there is always some factors which can put some brakes on their growth. Okay, in the short run, it is possible. In the short run, we all know that short runs are those conditions wherein the factors or the input factors, they cannot be changed readily at a whim fancy. So in the short run, it might be possible that a company is exhibiting a supernatural growth, wherein the growth rate is zooming past your eye, or the discounting rate. But with the passage of time, the growth becomes more sedate, it becomes more docile, the growth becomes more and more realistic. It is never possible for the company, for any company in the world, in a long run, to be on such a hyperballistic mode. It is never possible that in the long run, each and every company, no matter how profitable it is, to have a growth rate which is always ahead of the required rate of return from the securities, or the discounting rate expected by the shareholders or the investors. So somewhere or the other, there is always fear that in the long run the growth rate is always will come down to more realistic levels. It will come down to more, I mean, your sedate levels. So, and second part also, students, that we all know that any company, no matter how big it is, how small it is, they are always working within the boundaries of the of particular country. Although their operations might transcend the boundaries, they might be multinationals in nature also, but still they have to, somewhere or the other, they have to replicate, or they have to follow the overall GDP growth, or the overall growth of the country, or the economy. Again, the term comes that in a short run it might be possible that company's growth rate is more than the GDP rate, but gradually with the passage of time, since the company's performance is heavily reliant and heavily it is dependent upon the working, or upon the performance of the broad-based economy. So no company can ever say that, hey, we are absolutely untouched with whatever macroeconomic changes are happening around us from the government's point of view, from the government policies. No company can say that a particular government policy is totally we are totally insulated against a particular government policies. The government can't touch us. Particular change in the interest rate, inflation rate, your exchange rates, forex reserves, they are not I mean, bothering us. No, it is not the case. In the short term, in the short run, it might be possible, but in the long run, it is never possible for any company to deliver itself or disassociate itself from the growth rate of the economy. And we all know that no economy can sustain a very high growth rate for an infinite time frame. So booms and busts, they are bound to be there. So whenever the economies are going through a turmoil, the chances become very high that even in the long run, that gets reflected in the performance of the company also. So at best, the condition might be that the growth rate might be equal to the I, but growth rate zooming past the I, or the growth rate zooming past expectations of the required rate of returns from the investors from a particular company in the long run, it is something impossible. It is in a realistic ground, it is never possible. In the short run, it is okay, but since dealing with the company, we are dealing with a going concern. We should not be concerned only with the short run, but we should be concerned with the long run also. I hope this brief discussion is clear to you, students, and when we discuss the lesson, the valuation of bonds and equities, over there we shall be taking this thing on a great detail. So that's it for now, students. In our next discussion, we shall be seeing that how exactly the interaction between the I and G, that is I being more than G, is affecting the individual investment decisions of an individual investor. Thank you, students. Happy learning.